50 years ago, Americans lived through a perfect storm: high inflation, surging oil prices, a slowing economy. It was painful for most people, but for a small group of financially savvy investors who understood what was actually happening, it was the greatest wealth-building opportunity of their generation. That storm is back. History does not repeat itself exactly, but it rhymes. And right now in 2026, it is rhyming louder than it has in decades. So today, I want to show you exactly which investors got rich the last time this happened, which ones lost ground without even realizing it, and what that tells you about where the real opportunity sits today. What happened 50 years ago and why it matters now. In 1971, President Richard Nixon made one of the most consequential financial decisions in American history. He took the US dollar off the gold standard. In his own words, "I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets." That one sentence changed everything. It gave the Federal Reserve the ability to print money without limit. It gave the government the ability to spend without constraint, and it planted the seeds of an inflation crisis that would take a decade to fully bloom. Then, in 1973, the United States got drawn into the Yom Kippur War in the Middle East. Oil prices spiked. Inflation, already a problem, got dramatically worse. The Federal Reserve responded by raising interest rates aggressively through the late 1970s and into the 1980s. The job market took a beating. The economy slowed to a crawl. Now, fast forward 50 years. The pandemic triggered massive money printing and government spending. Inflation followed. Then, in 2026, the United States became involved in another Middle Eastern conflict. Oil prices surged again, and now the same question hangs in the air. What happens to jobs? What happens to the economy? What does the Federal Reserve do next? The Fed today faces enormous pressure to cut interest rates, but with oil prices rising and inflation concerns growing, there is a real possibility they may have to raise rates instead, just as they did in the 1970s. We do not know exactly how this plays out, but we do know what happened to three different types of investors the last time the world looked like this, and that knowledge is worth a great deal. Three investors, three very different outcomes. Let us assume each investor put aside $100 a month consistently starting in 1971. That is $13,200 invested over 10 years. Here is what happened to each of them. Investor 1. The index fund believer. This investor put their money into the S&P 500 every month, rain or shine. By 1981, their $13,000 had grown to roughly $21,500, a gain of around 60%. That sounds good, until you realize that inflation over that same period ran at approximately 124%. Their money grew, but the cost of living grew twice as fast. In real terms, they lost purchasing power. The stock market over that turbulent decade could not keep up with inflation. Investor 2. The saver. This investor kept their money in the bank, and to be fair, the 1970s were one of the few periods in modern history where saving money in a bank account actually made some sense. Interest rates hit 20% on mortgages. Banks were paying 8, 10, even 12% annually on deposits. By 1981, the $13,200 had grown to around $20,000, a gain of roughly 53%. Still not enough to beat inflation, still a loss in real terms. But the saver felt secure because they never saw their account balance fall. That psychological comfort, however, came at a price. Investor 3. The opportunist. This investor studied what was actually happening in the world and made a deliberate choice. They put their money into gold. By 1981, their $13,200 had grown to approximately $45,500, a gain of 245%. That crushed both the stock market and the savings account. It more than doubled the rate of inflation. Case closed, right? Not quite. Stick with me, because this is where the real lesson lives. The 20-year picture changes everything. Let us extend the timeline. Same investor, same $100 a month, but now we look from 1971 all the way to 1991, 20 years. Total invested $24,000. Inflation over that period, 236%. Here is what happened. The S&P 500 investors saw their money grow to over $133,000, a gain of approximately 430%. For the first time, they decisively beat inflation. The stock market, given enough time, did exactly what it is supposed to do. The savers' story got harder. When interest rates were high in the 1970s, their savings grew well. But as rates fell through the 1980s, so did their returns. By 1991, their money had grown to roughly $60,000, a gain of about 115%. Well below inflation. A significant loss of real purchasing power over 2 decades. And the gold investor? Their portfolio, by 1991, had grown to around $52,000, a gain of approximately 100%. Gold, the runaway winner of the first decade, finished dead last over 20 years, worse than saving in a bank, far behind the stock market. Why? Because gold is not really an investment, it is a fear trade. People buy gold when they are frightened about the dollar, about war, about economic collapse. When those fears eased and interest rates rose, gold crashed. The investors who bought it at the peak and held it suffered for a decade. The lesson nobody talks about here is the insight that separates serious investors from everyone else. Gold investors who bought early and sold at the peak did spectacularly well. Gold investors who chased the momentum and held too long gave it all back. The difference was not the asset. The difference was understanding why they owned it and knowing when that reason no longer applied. This is the mistake most people make today. They watch CNBC. They scroll Reddit. They ask ChatGPT what to buy. And by the time something appears on those channels, the smart money has already moved in. Regular investors buy the peak, hold through the decline, panic, and sell the bottom. That is not investing. That is an expensive way to transfer your wealth to people who understand the game better than you do. Warren Buffett said it plainly, if you do not understand what you are buying, you probably should not be buying it. Where the real opportunities are right now. So who is the opportunist in 2026? What does the equivalent of buying gold in 1971 look like today? It starts with following the money, not the headlines. The money. When oil prices spike, energy companies benefit. Their revenues rise as the commodity they sell becomes more expensive. That is not complicated. It is cause and effect. When geopolitical tensions rise, defense and aerospace companies see increased government contracts and higher demand. History has proven this pattern consistently across every conflict of the past century. When chip shortages emerge, and they are coming, driven in part by helium supply constraints, semiconductor companies and the industrial suppliers that support them move into the spotlight. And here is the one that most people are getting wrong about artificial intelligence. Everyone is talking about the big AI names, but the real infrastructure play is deeper. Data centers, semiconductor manufacturers, cooling technology companies, energy providers that power the compute. These businesses are essential regardless of which AI company wins the race. Whether the future belongs to OpenAI, Anthropic, Google, or someone we have not heard of yet, all of them need the same backbone to exist. That backbone is where the durable opportunity lives. Which investor are you? Before you make a single move, answer this question honestly. What is your actual strategy? If you are a saver, understand the trade you are making. You are accepting the certainty of losing to inflation in exchange for the psychological comfort of never seeing a loss. That is a legitimate choice, but it should be a conscious one, not a default. If you are a long-term stock market investor, the history is on your side, but you must stay the course through recessions, crashes, and corrections. The 10-year picture can be painful. The 20-year picture has historically rewarded patience. That only works if you do not panic and sell at the bottom. If you want to be the opportunist, you have to do the work. You have to understand what you are buying and why. You have to know when the conditions that made an asset attractive have changed, and you have to be willing to move before the crowd, not after the headline. The investors who built real wealth in the 1970s were not lucky. They were informed. They understood the forces driving the economy, they identified which sectors benefit from those forces, and they acted with conviction before the rest of the world caught on. The same opportunity exists today. The same forces are in motion. The same three types of investor are playing the same game. The question is simply which one you choose to be. The bottom line: inflation is not going away. It has been a permanent feature of this economic system for over 50 years, and it will remain so. The only question is whether your money grows faster than it or slower. Savings accounts will not save you. They never have, in any decade since 1971. The stock market, over long enough horizons, has historically won. But you have to be a genuine long-term investor, not someone who buys high and sells in a panic. And for those willing to study, to understand what they are buying, and to think about where money is actually moving before the headlines tell them, the same kind of life-changing opportunity that created a generation of millionaires 50 years ago is sitting right in front of you. Most people will miss it. They always do. You do not have to be one of them.